Every time a new AI model writes a complex line of code or generates a high-definition video from a simple text prompt, it burns a massive amount of physical electricity.
Right. Just an unbelievable amount of power.
Yeah. I mean, the tech giants have the software side completely figured out, but right now they're slamming into a 10,000-ton brick wall.
And that wall is the physical power grid.
Exactly. So if you want to understand the future of the AI economy, you can't just look at the software developers who are writing the algorithms. You have to look at who controls the physical pickaxes and shovels.
Which, in this gold rush, means heavy-duty electrical grid connections. Because without power, the most advanced artificial intelligence model in the world is just, a very expensive, very quiet piece of silicon sitting in a dark room.
Wow. Yeah, that's a great way to put it. Which brings us to our mission for today's deep dive. We're unpacking a stack of financial reports, market data, and analyst notes on a company called Keel Infrastructure.
Yeah, and they are sitting right in the absolute center of this AI power crunch.
They really are. So let's establish the baseline here. Keel is flashing across all the financial news tickers today, primarily because of its price action.
Right, the tape is just going crazy today.
It is. The stock is currently trading right around $4.05. That is a staggering 27.35% gap up on the day.
From a previous close of, what, $3.18?
Yep, exactly, 318. And zooming out on the chart, I mean, they're still sitting about 45% below their 52-week high, but well above their $2 low.
So it's a highly volatile asset. I mean, prior to this morning's gap up, the stock had actually bled out nearly 34% over just the previous 5 trading days.
Oh, wow, really?
Yeah, yet it's still holding a year-to-date gain north of 47%. The market is just aggressively trying to price in a company that is fundamentally changing its entire identity.
Okay, let's unpack this. Because if you just look at their Q1 2026 numbers, it looks like a company in a total death spiral.
It really does. The numbers are ugly.
Very ugly. Revenue fell 22.4% to roughly $36.99 million, and a huge chunk of that was their crypto mining revenue, which just tanked. It dropped nearly 35%.
Right. And the bottom line took a massive hit, too.
Yes, swelling to a net loss of $145.35 million. That's a 161.6% increase in their net loss year over year.
Which sounds terrifying. But here's the context. They aren't losing clients to competitors. They are deliberately suffocating their own revenue.
Wait, deliberately?
Yes, it's an intentional contraction. They are aggressively kicking out their crypto miners to make room for high-performance computing, or HPC, and AI colocation.
Oh, I see. So it's like a factory owner literally ripping out old, obsolete assembly lines to build a state-of-the-art cleanroom.
Exactly. They are pulling the plug on functional, revenue-generating legacy systems to completely overhaul the physical footprint of these data centers.
So the wallet takes a massive hit during the renovation, essentially.
Right. In a vacuum, those Q1 numbers look disastrous. But management is taking the systems offline, eating the financial hit today, to prepare the sites for the next generation of computing.
And the mechanics of that transition, that's what makes it so painful, right?
Yeah.
Because crypto miners are essentially just glorified space heaters.
Pretty much, yeah.
You can run them in a basic retrofitted warehouse with giant industrial fans just blowing ambient air across the server racks.
But high-performance AI clusters require incredibly dense power delivery. You can't just sweep up the dust from a Bitcoin rig and drop in an AI supercomputer.
Right. I was reading they need specialized liquid cooling piped directly to the processors, plus structural reinforcements for heavier server racks.
And incredibly low-latency fiber optic networking, too, because the GPUs have to constantly talk to each other to train these AI models. The capital expenditure required for that kind of infrastructure upgrade is just immense.
So they take the revenue hit during demolition and rebuilding, betting that the future margins on leasing space to top-tier AI firms will be way higher.
Astronomically higher. And much more stable than the highly volatile, commodity-driven revenue of Bitcoin mining.
But the market needs proof that this transition isn't just a giant money pit. So what's the milestone to watch here?
Management set a very specific goal for 2026. They want to secure 3 signed leases by year-end for these new HPC and AI facilities.
Getting those signatures on paper establishes the new baseline.
Exactly. It proves the thesis.
Okay, but knowing that Keel is pivoting into this highly competitive AI space, I mean a space dominated by trillion-dollar tech giants, what actually gives them a competitive edge?
That's the billion-dollar question.
Right. Like if tech giants have unlimited money and this insatiable need for data centers, why wouldn't they just build this infrastructure themselves? Why rent from a company like Keel?
Well, the limitation isn't capital, it's time and regulatory friction. Keel CEO Ben Gagnon framed this perfectly. He said power availability is the single biggest bottleneck for AI growth.
Ah, so you can't just plug a massive 100-megawatt AI data center into the local grid like a toaster?
Not at all. The tech monopolies want to build their own centers, but they cannot deploy capital fast enough to overcome the physical reality of the grid. You have to source high voltage transformers, which right now have lead times stretching into years.
Wow, years.
Yes. Plus, you have to lay heavy transmission lines, navigate local zoning boards, pass environmental reviews, and convince regional utility monopolies to agree to these massive grid interconnections.
So building power access from scratch is basically a 5 to 10-year process of pure red tape and heady civil engineering.
Exactly. And the AI arms race is happening today. The tech giants simply cannot wait until 2035 to bring new models online.
Which brings us to Keel's primary moat, because their core asset isn't software at all. It's a 2.2 gigawatt North American power development pipeline.
And for context, a single gigawatt is roughly the capacity of a large commercial nuclear reactor. It's enough to power hundreds of thousands of homes.
That is massive.
Yeah.
Controlling 2.2 gigawatts of potential power is huge leverage, where the most valuable companies on Earth are desperate for electricity.
It really is.
But hold on, let me push back a little. Isn't a pipeline often just corporate speak for a long-term plan? I mean, how much of this is real right now? Let's separate the energized reality from the theoretical plans.
That's a very fair question. So out of that 2.2 gigawatts, 341 megawatts are actually energized right now.
Okay, so the substations are built, the plugs are live, and the power is physically flowing.
Yes. And another 430 megawatts are secured via executed utility delivery agreements. That means the utility company is legally committed to delivering that specific capacity to Keel's sites.
Okay, so we have a little under 800 megawatts that are either live right now or legally contracted.
Right. And the geographic footprint of those assets is highly strategic. They have grid interconnections established in Pennsylvania, Washington State, and Quebec.
Oh, Quebec stands out. I saw they had a recent bullish win there, securing municipal consent in Sherbrooke for a 96-megawatt transfer and a land purchase.
Yeah, and Quebec is fiercely protective of its hydropower resources. Navigating that bureaucracy and securing municipal approval is a significant validation of Keel's ability to actually execute on these deals.
They're essentially allowing AI companies to skip a 5-year line. Keel already waited in line to get these grid connections for their crypto operations, and now they are monetizing that spot in the queue.
Exactly. It creates a massive time-to-market advantage. However, retrofitting nearly 800 megawatts of capacity with liquid cooling takes an unbelievable amount of capital.
Which is where it gets really interesting. Keel has built a massive war chest to fund this exact transition.
I certainly have.
Looking at their pro forma liquidity, they're sitting on roughly $937 million. I mean, a company whose stock was trading near $3 yesterday is holding nearly $1 billion in liquidity.
Yeah, that capital structure requires a much closer look because the liquidity came in two distinct tranches. Back in May, they reported $533 million in liquidity.
And that was a mix of cash and crypto, right?
Yes, roughly $336 million in cash and $197 million in unencumbered Bitcoin. So digital assets they own outright and can liquidate to fund operations.
And then in June, they aggressively tapped the debt markets. They issued $458 million in convertible notes.
Right, which yielded about $445.4 million in net proceeds after clearing fees. Combine that with the May figures, and you arrive at that $937 million runway.
Which management projects will fully fund their development and general expenses all the way through 2028?
So having the capital to survive the transition is step one. But the broader market reaction we are seeing today with this 27% spike, that isn't just about the balance sheet.
No, it's about institutional buy-in. BlackRock just dropped a Schedule 13G filing revealing an 8.4% stake in Keel. That is nearly 51 million shares as of June 30th.
Taking down an 8.4% passive stake is a definitive signal. When the world's largest asset manager takes a position of this magnitude, it forces other institutional players to reassess the asset's risk profile.
It totally shifts the sentiment.
It signals to the street that institutional capital believes the pipeline is credible and the pivot to AI is viable.
And analysts are jumping on board too. BT analyst Gregory Lewis initiated coverage with a buy rating and an $8 price target.
Which is huge. Even after today's gap up to $4, an $8 target implies roughly a 100% upside from current levels.
And Jim Cramer even highlighted Keel recently as a potential long shot winner. Plus, insiders are actually buying the stock.
Yeah, that's a key detail. Over the last 90 days, insiders bought a net 304,809 shares. Insider buying during a period of massive operational disruption and negative earnings, that is a very strong indicator of internal conviction.
So what does this all mean? We have a company executing a painful but necessary pivot, sitting on a massive power portfolio, backed by $1 billion in liquidity, validated by BlackRock, and seeing internal insider buying. It paints a very bullish picture.
It does on the surface.
But we need to flip the coin and stress test this thesis. Let's do a reality check on the risks. If they have the money and the land, what could go wrong? Let's break down the bear case.
We'll start with the execution risk on that pipeline. We noted earlier that of the 2.2 gigawatt pipeline, 341 megawatts are energized and 430 are secured.
Right.
That leaves roughly 1.5 gigawatts classified merely as expansion capacity.
Which is the vast majority of their stated pipeline.
Yes. And that 1.5 gigawatts is still under application or evaluation by local utility companies. It is entirely unsecured.
So if a utility board determines the regional grid cannot handle the load, or if local zoning blocks the expansion, a massive percentage of Keel's valuation thesis just vanishes.
Exactly.
It's the real estate equivalent of having zoning approval for an empty lot. Having the permit doesn't mean you have a finished rented-out skyscraper. They still need creditworthy tenants in actual construction.
And while they are racing against that clock to build, they are carrying a massive debt shadow. We outlined their billion-dollar war chest, but that capital is highly levered.
Let's talk about that debt. Keel carries $1.046 billion in principal from 2 convertible note issues.
Carrying over $1 billion in debt for a company valued near $4 a share is a heavy structural burden.
It's huge.
Yeah.
Though the immediate cash flow impact is pretty manageable, right? Because the coupon rate on those notes is incredibly low, only 1.25%.
Right, which translates to an annual cash interest expense of roughly $13.8 million. So they are not at risk of near-term bankruptcy from interest payments. The true risk lies in the convertible nature of the debt.
The dilution risk.
Exactly. The newer notes have a conversion price near $7.41. If the stock appreciates rapidly, the debt holders are going to convert that debt into equity.
Flooding the open market with millions of new shares.
Yeah.
Permanently diluting the equity value for existing retail investors.
To mitigate that, management did purchase capped calls. It's essentially an insurance policy on their own stock price, mitigating dilution up to a ceiling of $11.86.
But once it breaks past that, the dilution engine kicks in, regardless. We should also address the rumors flying around today, because we're seeing massive volume against a high short interest. 17.25% of the float is currently short.
And at a beta of 4.12797, indicating extreme volatility.
The message boards are screaming about a short squeeze. Are we just seeing a short squeeze today?
Unconfirmed speculation definitely exists, and short covering is likely amplifying the price movement today. But it's crucial to view a squeeze as a symptom of the BlackRock news, not a guaranteed outcome or a core investment strategy. Basing a thesis purely on squeeze mechanics is very dangerous.
So synthesizing all this, Keel is an infrastructure play with a massive war chest, transitioning from crypto to AI, validated by a massive BlackRock stake. But they are carrying a heavy $1 billion debt load and serious execution risks.
It is a pure execution play at this point.
Looking ahead, what's on the catalyst calendar? What should listeners be watching for in the near term?
Well, Keel's Q2 2026 earnings are coming up fast on August 10th. The market is going to be laser-focused on their cash burn rate during this demolition phase, the value of their Bitcoin holdings, and most importantly, any actual leasing progress.
The race to secure those 3 signed leases.
Exactly. Analysts want updates on specific sites like Panther Creek, Sharon, and Moses Lake. They also need to watch for the final provincial review from Quebec's Ministry of Economy, Innovation, and Energy regarding that Sherbrooke transfer.
Approval there would significantly de-risk a portion of their pipeline.
Definitely.
It is a perfect case study of a company acting as a crucial middleman, securing power for the AI boom. Which leaves us with a final thought to mull over. Right now, companies like Keel are absorbing the red tape and construction risks in exchange for long-term rents.
Great.
But as AI continues to demand exponentially more electricity over the next decade, how long will it be before the trillion-dollar tech giants stop renting from intermediaries? When do they stop buying software startups and start trying to buy, build, and monopolize the raw power grid entirely for themselves?
That shift would completely redefine the regulatory landscape and what a tech monopoly even looks like.
It's definitely something to think about the next time you ask an AI to write an email and some power substation in Quebec has to spin up a transformer. Thanks for joining us on this deep dive. We will catch you next time.